We are proud to welcome keynote speaker Lauren Dillard, Executive Vice President of Global Information Services at Nasdaq. Prior to her current role, Dillard served as the head of Investment Solutions segment at the Carlyle Group, where she managed more than $30 billion in assets and a team of 200 professionals across 6 international offices. She'll be chatting with DealCloud Co-Founder Ben Harrison about the biggest trends affecting dealmakers today, as well as organizational best practices for the leading firms of the future.
It was great to hear from Stephanie this morning. Some really exciting insights and key takeaways there. I learned a lot from the session. My name is Ben Harrison, and I wanted to take a minute to introduce you and welcome you to the DealCloud Connect 2020 conference. We're excited to have you. We've got a bunch of great content for you over the coming days, and we're looking forward to spending this time with you. Before we get going, I'd like to revisit the topic of growth in the connected firm that Thad and John mentioned this morning. For many of our clients, the connected firm has been a long road. Building an integrated ecosystem of technologies and data to help support your firm is a challenge. And over the last 6 months, we've had an opportunity to spend an increasing amount of time with our clients working on this. When the market dislocated in March and April, our clients reached out and we were able to develop deeper connections with them than we've had in the past. Delivering a collaboration and a software platform that helps our clients work together in this work from home environment has allowed us to really drive home the adoption and the value that this platform is delivering. So we're excited to talk more about that today. And as we get going here, we wanted to share a couple key growth statistics with you that we've experienced. Many of you who have been our clients for years or have been at previous Connect conferences are familiar with this chart. Each year we like to share our growth with you and what we've accomplished. We recently achieved over 900 clients across the financial services sector. We're working in many sectors: banking, private equity, growth equity, venture, corporate development. But I'd like to call out 2 sub-verticals that we're really excited about. We've seen tremendous growth this year in the investment banking sector and also in the real estate sector. Bankers are embracing the cloud, and we're seeing adoption rates in this work from home environment like never before. We're also seeing tremendous demand in the real estate markets. There's been exciting opportunities for investors there, and that has certainly helped our business grow in those particular areas. We're going to talk a little bit more about those in this keynote here, and I'd like to introduce our speaker this morning. Her name's Lauren Dillard. She works with Nasdaq. She's the Executive Vice President of their Information Services business, and she's been hard at work on also building a suite of software to support their private capital markets business. Lauren, we're really looking forward to hearing from you. Welcome.
Thank you, Ben. I'm excited to be here with you today.
Lauren, before we jump in, tell us a little bit about the businesses you run at Nasdaq and what you're focused on right now.
So the Global Information Services business is the data analytics and index business within Nasdaq. It's one of our 4 business unit lines. It represents about 30% of the revenues here at Nasdaq, and we have just about 900 people on our unit. I think when you think of Nasdaq, most people think of the exchange, and we certainly should talk about that and the trading associated with it. But really, Nasdaq is a global technology and data company. Technology being that we power over 150 markets around the world. That would be exchanges that are frankly competitors, but also super interesting new markets like the UK Football Index, the Hong Kong Jockey Club, and some others like that. And the data and analytics business, which is our business, has a very large index franchise, which we can talk about. We actually had a recent announcement of a next-gen suite in innovation with Invesco, as well as data from the exchanges, alternative data, as well as analytics to power the investing community.
That's great. Well, we've read a lot about the acquisitions you've done recently. I know it's been busy over there. We've got some exciting topics for our audience today, so we'll jump into the agenda here. We're going to talk a little bit about some of the trends and dynamics we're seeing in the industry. We're going to talk about the institutionalization and the importance of this data that they use inside of DealCloud, and certainly it's part of the Nasdaq Information Services business. And I also want to spend some time on the private capital markets business you're building. You have the exchange side of your business, but there's an area of Nasdaq where you're working in the private markets that overlaps with a lot of our clients who are tuned in today and part of today's audience. So looking forward to jumping in on each of these. But before we get going, we've seen a ton of activity in the technology and the IPO markets especially. Nasdaq has been a big beneficiary of this. Obviously, a lot of these companies are being listed with your exchange. You've won some of the biggest names out there. You've gotten both of the Zoom deals, the Zoom technology we're using right now for this meeting. You've got ZoomInfo, Datadog, Peloton, just a lot of the core tech companies. Tell us a little bit about what the market is like today, how you're positioned, and why you're winning such a strong share of these mandates.
Sure, I'm happy to cover that. I mean, what's really interesting is, when COVID hit, if you looked at the companies that accessed the capital markets then, it was really healthcare and biotech at the time. And then even since April, we've seen just an extraordinary number of listings. I think there were 15 IPOs either a week or two ago, in a week alone. And so, I mean, I think what you're seeing is investors wanting access to the sort of new digital modern economy. I mean, I like to call the Nasdaq 100, it represents kind of the modern industrial way we all live. And you mentioned many of the names that I often cite. I mean, Zoom went into the Nasdaq 100 just this year, as did Moderna. So you see healthcare and tech. And the next gen is a super interesting group of companies that aren't just technology. You've got Lyft in there, you've got Garmin, but really what you're seeing is technology is underpinning companies everywhere. And certainly there has been an acceleration of digitalization. I think, a CEO said 2 years of digitalization happened in the first 2 months of COVID. So whatever your digital roadmap was within technology, it was definitely accelerated, and Nasdaq has definitely seen those companies accessing the capital markets, and it's definitely seen investors interested in providing capital to those companies.
So Lauren, we're seeing a tremendous amount of money flow into these markets and into the tech industry specifically, and it's happening at a pretty high valuation. Help us understand what's driving the dollars to flow at this rate in this format. If you're an institutional investor and you had exposure to restaurants or travel or leisure, you can understand rebalancing a portfolio and pooling dollars into this type of asset. But I'm interested in your perspective and Nasdaq's perspective on what's causing the markets to be as open as they are today, and why we're seeing such strength in this particular end market and industry.
Thanks, Ben. I mean, look, you have a lot of clients that are investors, so I think they can obviously speak to the valuations. I think what we see is, open, transparent capital markets are a way that investors can express both their confidence in companies, what they see as the way we're all living, where they see growth. So these companies accessing the capital markets and the flows into these companies, we actually view as investors' expression of confidence. And again, we saw healthcare companies accessing the capital markets early during COVID. Now we're seeing both tech companies, but also consumer companies, as well as additional healthcare. So really, I mean, we at Nasdaq want investors to actually have access to the value creation in many of these companies. And so accessing the capital markets and that expression, we view as a positive. But I think what you're seeing is, frankly, the confidence of investors in many of these digital companies, many of the way that we are living today. I use that modern industrial reference, but that really is it. And I think you're seeing an expression of that as these companies access the capital markets.
Do you think any of that's due to the nature of the revenue or the contracts? I feel like SaaS is such a popular business model today, and we certainly understand it, being in that business ourselves. But is that confidence related to the strength of some of these companies' P&L and balance sheets, given the nature of the recurring revenue that we see in kind of these next generation technology companies?
I think any sort of subscription business where there's recurring revenue gives investors both line of sight, of course, into the revenue, and also confidence. And many of the metrics that we all use and in our companies are around ARR and retention. So it gives a really good feel for both, the company's health, but also the company's future health and the confidence in those revenue streams. You've even seen that here at Nasdaq. We have transaction business, but also our technology and data business is heavy around ARR and subscription. So we use all those same metrics ourselves.
Well, it's a tremendous fundraising vehicle, and I think one of the other interesting, I guess you could say it's really having a resurgence, but fundraising options that we've seen a lot of companies using recently is the special purpose acquisition vehicle, or the SPACs. I think you've landed a lot of those listings as well. Tell us a little bit about what's happening in that market. I think I read that in one given day we had 8 or 9 in a single day. So it's certainly hot, and would be interested in your perspective there.
Yeah, we definitely have seen a rise in SPACs. I think that goes without saying. The head of our listings business recently said there was 125 out searching for deals, and then I heard another reference to 180. So that's the range. I view it as an option, and again, it's accessing capital markets in a different way, which really interesting for your clients and many of ours as well. Is you see a rise of this within the private capital space, which makes sense because a lot of once the SPAC has accessed capital markets is finding a deal, so it's deal sourcing. But SPACs have been around a long time, but you certainly are seeing a rise of them this year without question. And I don't know, we will see as they have their investing period when they can find and access those deals. So we'll actually really, I think, see these vintages play out over the next 18 months.
It's going to be interesting. Do you think there are any advantages for the companies who are thinking about the optionality? Are there advantages going in one direction or the other?
It's really interesting. Having spent so much time as I did in the private market space, I view it as actually an extension of private markets because to some extent it's a blank check company going to source a deal. But now being on the exchange side, it's really interesting because it's accessing capital markets. So to some degree, we like to see it in that, again, it's providing a broader group of investors access to maybe some of these private companies they wouldn't have otherwise had by listing SPAC, and then of course going and sourcing those deals. So I think it's just one of the many tools, in this case accessing the capital markets, and again it's allowing investors to have the ability to express themselves. In this case it's confidence in the deal makers that are going to find these deals.
That's great. Well, I want to shift topics here briefly and hit on something that is near and dear to your experience prior to Nasdaq at Carlyle, and talk a little bit about the fundraising environment and some of the sentiment that we're getting back from our clients and users. So we release, I think you're familiar with this, but our DealMakers Pulse survey goes out twice a year, and we ask a series of questions of our clients to get a sentiment or a pulse on the market. And in one of our recent efforts in launching this, we talked a little bit with our clients about the status of their fundraising. And what we heard back from them was that not all of them, but a small percentage of them, about 12%, were putting their fundraisers on hold, and about 6% had actually downsized the raise that they were working on in an effort to get those funds closed and start executing on deals. I know that Nasdaq has a lot of data in this arena. Through your investment in EVICE and a number of other companies, you've got pretty rich information about the market. Tell us a little bit about what your data is showing and what you're seeing.
So we have an interesting tool called Market Lens, and it actually shows searches and it shows commitments, and it is part of our, to your point, eVestment portfolio of tools. And really what we're seeing, and it's really interesting, is it gives you insight not just into the searches that are ongoing, but into allocation changes, which therefore then gives you sort of forward-looking insights and analytics into where additional searches will happen. And of all of our suite of investment products, interestingly, the Market Lens tool, even during COVID, but certainly year over year, has grown at a really rapid rate. I mean, well over 100%. And I think what that means is people are, again, everyone's at home. You've accelerated your digital roadmap. You need to see searches. You need to see who people are comparing you against. You need to see both where there's new allocations, where allocations are at risk. And just to give you a sense of the investment breadth, there's 2,500 plus sort of individual logo client users within eVestment. You've got close to 800 asset owners, you have consultants, and then you have a whole host of institutional asset managers. And so you've really got a whole ecosystem there that's collecting data, but the market lends the rise of the use there, especially as it relates to private markets as well, really gives really interesting insights into where allocations are going and where RFPs are coming out and changes to investor sentiment and investor behavior. So we look at across market lens for insights. We do sell those back to the clients, of course, so you can see who you're being compared against, where you're falling out of RFPs. And again, it's a big ecosystem. So at the beginning of COVID, actually, we started collecting COVID response policies, which would make sense. I mean, again, if you're an investor or you're an allocator or you're a consultant, you're wanting to see how people are behaving and responding. And then we actually just in August rolled out again, as part of the ecosystem, so driven by both our investor community, the asset managers, and the consultants, an ESG questionnaire. So again, it's all about collecting data. We do believe we're in the business of helping collect data and give insights to the people who are investing. So many of your clients, it's not our business to invest, it's our business to provide valuable intelligence to those investors. So we have seen really interesting data here. You see some of the searches on the screen now, and you can actually see the changes of behavior in some of the searches that are out there.
We've got an interesting overlapping trend with you here around the private debt. We've been very successful in growing our business in that market. And if you look at the asset allocation you have here, Lauren, a lot of these look about equal, but there seems to be a little bit of a bump in the private credit or private debt markets. Tell us a little bit about that and what you're seeing there.
Ben, you're spot on. And if you go to the next slide, actually, that is exactly what our data is telling us. So you'll see here both the signals and the existing mandates for both private debt or private credit, as well as real estate, including real assets, are both increasing. So that does not surprise me at all. I think those are two growing areas of allocations, certainly says that within our data. What was really interesting is the last update we did, both in Asia and in Europe with this information, actually showed the same thing. So this is actually a global signal. So in Europe, real estate and real asset searches and mandates and allocations increased, which frankly surprised me a bit.
I mean, you would think with everybody working from home that the commercial real estate asset class would be a little bit of a fringe or kind of risky asset at this moment, not knowing when we're going to go back. What do you think is driving that? The private debt is interesting because you've seen a lot of banks exit that market, but do people think that they're going to benefit from the dislocation in the real estate market, or how are they looking to play that?
Our searches aren't just within real estate showing searches for opportunistic real estate. Actually, we see an increase around core. So I think that's a bit of it as well. And again, some of it's forward-looking, some of it's a change in the overall allocation. I do agree with you on private credit and private debt. I view the real estate changes in allocation maybe more around the core versus just opportunistic, meaning not just specific to commercial. And obviously, even within real estate, we show sector searches, and
Sure.
Clearly some of the sectors, logistics, have performed quite well. So, but it is really interesting because it is not just a U.S. phenomenon on these two increases and these two allocations.
Wow, it's an interesting takeaway. I wouldn't have guessed that. What are we seeing on the equity front?
eVestment started as the place to have long-only traditional asset management information. So, the equity piece of people's portfolio is still large. And when you look at the overall size, it's still a significant component. But we are seeing searches increase in the private, across all private capital. So that benefits, of course, you and your clients as well, as we continue to see allocations increase. But people are looking across the portfolio around the traditional long-only managers, and that could be everything from emerging international managers. Again, I mentioned ESG. We definitely see an increased search there, and we do have 4,000 plus hedge funds within the database. So, we really do see across pretty much all of the asset classes around both searches and potential allocation changes.
It's interesting with the public markets rebounding. We've got increased allocations over the past couple of years to the private markets. Are you seeing generally, is it your opinion that the institutional investors are going to continue these allocations and that we'll continue to see kind of bull market characteristics within the private markets fundraising as well? Does Nasdaq have an opinion there, or how is your team thinking about that?
I can only speak to the data we have, right? Which is in all of our forward-looking, and we'll go through some of these commitment analytics that we see both in mandates, in searches, in allocation changes. We do continue to see a rise of allocations in the data to the private markets. So even with accessing public capital, and even with, of course, we've got the index business under my business as well. So, we're able to see the flows into our passive products. We still continue to see allocation increases within the private market. So pretty much everything you'll see on these next few slides that we've pulled out of our data, and it's all just sort of strictly sourced from commitment data, will show that even year over year, investors continue to make commitments. So you've got private equity here, and this is year over year. And then if you go to the next slides, we have private debt, to your point, continuing to see steady allocations to private debt. So you don't see anyone really backing off. And I think that has to do with, I would argue, investors' confidence in wanting to see those investors deploy capital. And then if you move to the next slide, you have real estate or real assets. And you're seeing the same thing. So we haven't seen the number of commitments decline, and even with the enormous number of IPOs that we've had accessing the capital markets, we do see commitments, at least the data says that, at least as of now, continuing to access the private markets, which should make you happy, of course.
Of course, it's a great set of data, and it's a great indication for our clients and our users and the people who are part of the conference today. The market is strong, and it's interesting. We had the quick drop in the public markets with a strong rebound, but it looks like the strength that exists in the public markets, that the private markets are just as strong as those. Would you say the data indicates that?
Yeah, I mean, all the data that we have shows continued allocation changes, continued increased allocations to the private markets, across really all, whether you look at private equity, whether you look at private debt, or whether you look at real estate. And it's consistent year over year. So I think that's the investors expressing their confidence in the investing community within this space and the access to that value. So, I mean, we haven't seen any data that has shown us otherwise.
Well, we've certainly experienced that here. I think year over year, our business has continued to grow, and beyond just the strength of the market, similar to other collaboration tools that enable teams to meet virtually and connect and work effectively from home and from different locations, we actually saw a little bit of a spike in demand for our technology and our technology platform to support these groups across the private capital markets, whether it was real estate or venture, credit, or equity. So we're certainly experiencing that as a business. So I think the takeaways and the data that you have are in line with what our business has seen, and I think our clients and customers who are here today would agree with you. One of the things that you have been doing as part of your role at Nasdaq goes a little bit beyond the exchange business. It goes beyond the information services business, or I should say it overlaps with the information services business, but you've acquired a pretty large number of technology companies that service this same market: the private credit investors, the private equity investors, venture, growth, real estate. And given the bull market trend that we just talked about supporting this in market, it looks like Nasdaq is building an offering and an exposure to this segment of the market. Tell us a little bit about some of the companies you've recently acquired and what you're building here.
Sure. Thank you, Ben. And I completely agree with you. I think we have seen an increase in adoption rates as well. And it all gets back to that interconnected way we're living. We all went home, and so if you had a roadmap to accelerate some of your investment in technology, whether it's to share data or across your workflow, you accelerated it, or that's what we're seeing. So to go to your question, fundamentally, as mentioned, Nasdaq is a technology and data company at heart. It obviously, the roots of it were actually taking digital and applying it to the equities market back when it wasn't, which is so strange because it's such a mature market now, obviously, and it has to do with latency and the depth of data and how fast you can get the data out. So if you really think about that kind of being the core, then you look around and you say, okay, well, where else is there investment workflow that needs to be digitalized, automated? Where else could we be driving better data? And fundamentally, I think just as you guys do, we feel like within the private market space or alternative space, there's definitely opportunity for investment workflow and efficiencies and frankly, better data. And really data going through the entire ecosystem. And so that's the way we think about it. So you are right. I mentioned eVestment, but eVestment joined the Nasdaq family in 2017. So it was kind of the institutional long-only database with an ecosystem, and it actually covers hedge funds, also has a great depth of information around private markets. So funds, positions, and it really is a pre-commitment tool for fundraising. I mentioned Market Lens, seeing how you position yourself, seeing how others are positioning themselves. And then in March, we closed on an investment called Solovis, which is a cloud-based multi-asset class tool. So
Sure.
If you think about eVestment as being kind of the pre-commitment place that investors and consultants go, Solovis is a post-commitment. So you can look at your entire portfolio. What really interested us is it's light, it's cloud-based. It actually allows you to see your entire public portfolio, but also across your private portfolio. So we viewed that as an important extension of our capabilities. So that when people need to look at their entire portfolio, rebalance, they can go into eVestment, do their research, do their manager diligence, come back into Solovis, and then it also covers the private markets, which again, much in the same spirit as what you're trying to do, allowing people to have better access, better visibility into the workflow. That's what Solovis brings to the table there. So those are both important pieces of kind of the way we're thinking about the entire investment lifecycle. We have a liquidity platform, which is interesting. So that helps both GPs and LPs actually transact. So it's actually just technology that enables the secondary market to transact in a smoother way. That's an area that we think still there's opportunities for efficiencies. And then we have a venture arm that we've made some strategic investments out of. We do that where we think there's really interesting teams building interesting technology, or whether, frankly, sometimes it could be disruptive. It could be a place where we don't bring the entire capability into our suite, but we, for whatever reason, bring either distribution capabilities or a commercial relationship. And so we've done several investments, again, focusing the private markets out of that pool as well. So really, it all goes back to, what technology can we bring that makes the investor's life easier, and what data can we provide that, and again, enables investors to do what they do really well. Go find deals with your help, source deals, look at the deals, and then what we provide is the technology and the data within the intelligence to make investing decisions. So that's the way we think about it. And we're constantly, talking to people about, both pain points and, obviously lived some of those as well. And I think there's a lot of opportunities that are still untapped, as you guys probably do as well. So we're talking to our clients about pain points, about interesting data. I should also mention we have an alternative data platform. So if you think about providing sort of substance to investment thesis, our platform there takes large amount of data sets and actually finds interesting signals. So it's actually born in kind of the trading community.
Yep.
And services a lot of hedge funds, but we're actually seeing adoption of that across private equity, across venture, across corporates, frankly. So if you think about, when COVID hit, all of a sudden, any interesting data set around supply chain, around what was going on with the airline industry.
Sure.
The kind of classic example that I use in that case is insurance companies write insurance policies for new car sales. Their business is insurance, right? But in doing so, they actually see the new car sales well before those numbers come out. So that's a classic example of a data set that has something interesting buried in it that someone else finds valuable. That's the new car sales for Tesla versus the insurance company. So that's part of our sort of data suite as well. So again, it's constantly just finding ways and finding interesting data and intelligence to provide to investors on super modern technology.
Lauren, I want to focus in on one of those points you made around the secondaries market, because we're seeing a tremendous amount of activity here. We support a lot of these firms that are really making the market for liquidity in the private markets, and it's really been a huge growth sector in the last couple years. If you think about what's happening, we're really starting to blur the lines between the liquidity that exists in the public markets, trying to create some of that liquidity in the private markets. Nasdaq is sitting on both sides of that liquidity with offerings in both places. Talk a little bit about what you're doing to support the secondaries business and what you're seeing in that market, because similar to the private credit trends and growth, we've seen the same thing in the secondaries arena.
Yeah, sure. So the liquidity platform that Nasdaq formed actually originally and still does service private company shares transactions that companies lead, sometimes in advance of their IPO,
Sure.
sometimes to help employees have liquidity. So that was actually the genesis of it. It was sort of the companies in advance of when they accessed the public markets. After Adina Friedman, who's the CEO, had spent some time at Carlyle and came back, she realized that as a technology provider, the secondaries market that you're talking about could use automation, and not automation necessarily to change or disrupt where all of the secondary players sit. I know there are many of your clients,
Sure.
but rather to actually, frankly, help drive efficiencies, to help better data transparency, to help better price discovery, to frankly just automate the process. Anything that's still being exchanged, either via emails or through heavy paper could use some automation. So our liquidity platform now also services the funds side. So that would be exchanging of funds. They also went, before I joined actually, and spent some time with the IRS and got an exemption around the amount of any fund that can actually trade hands in a year, so that it's a private letter ruling around the publicly traded partnership rules. But the idea there is, again, where is there a need for automation across a workflow? And I think the secondaries market is an asset class of itself now. And any place that we can help drive efficiencies, that's where we like you, feel like there's an opportunity, again, around data or technology to help those investors do what they do really well, and to provide the technology and data to make them do it in a more efficient way.
Well, you see a lot of banks building practices today focused on that type of asset, and so I expect we'll see more and more transactions, and hopefully Nasdaq can help make those less complex and a little bit easier to execute.
Maybe we can just connect right into yours, and then people can automatically go from the sourcing to the rebalancing, and there we go.
That's great. Well, I want to ask you two quick questions as we close out our time here. We've got a couple other sentiments we've seen in our DealMakers Pulse survey. We asked our clients what type of deals they're closing, who's closing deals, and what they're seeing. Certainly NASDAQ has closed a lot of acquisitions recently, so you've as a corporate acquirer, you fall into one of these categories. And looking at the number of firms who are building new platforms and then doing add-on acquisitions, is this kind of in line with what you're seeing out there in terms of the kinds of transactions that are being executed today?
Yeah, I mean, look, I can say as a strategic, we obviously have our roadmap, as other strategics do, and we have a lot of conviction. And so if you have a strategic that has a roadmap and has conviction, then a time like this is just as opportunistic as any other time. And I would assume that probably is the same with the sponsors looking for deals. Some of which we started discussions, frankly, before COVID. some of which, because none of us are traveling and we are all at home, I would argue to some degree there's an efficiency there as far as interaction. But again, it goes back to, did you have your strategic roadmap and do you have conviction? And I say that as a strategic, not necessarily as a sponsor, although I'm assuming it probably applies to the sponsors as well. So these numbers don't really surprise me. I'm a little bit surprised on the 30% no deals. But that's hard to say because I don't know your entire group of investors within that space. Certainly, if it was brand new, I would understand because it was probably more difficult, especially if you have to diligence a large team. We were looking at acquisition with a large team that was actually not in the U.S. and it was going to be hard for us to get over there and actually do the diligence we needed.
I'm guessing those 30% no deals have got to be our consumer investors who were looking at things in the retail, travel, leisure, restaurant space, and probably took a quick pause on that to wait for valuations to reset and to see the shakeout of this. We also talked a little bit with our clients about how they're spending their time. We've certainly seen them engaging us as a technology vendor in much greater capacity. In March and April and May, we were able to spend time with our clients driving home the value of their deployments and making sure they were using the technology to the benefit of their firm because they were all scattered in different locations and from the kitchen table. But we did ask them where they're spending time, what they're working on, a nice distribution here of focusing on putting money to work, working with portfolio companies. I'm sure there's a fair number of workouts in process right now. Does this make sense to you? And how is Nasdaq spending its time right now as it relates to working with the portfolio of companies you bought recently or going out and chasing new assets?
Yeah, this doesn't really surprise me. If you think about it, I think we all were just adjusting in April. We all went from, everybody being in the office to everyone being at home, essentially the next day. And that would include, responding to our teams, understanding how everyone is. And you made a joke about the kitchen table. I quite literally sat at the kitchen table for the first month and finally had to just move because my husband was having to sneak in to get food. So this doesn't surprise me at all. Everyone's kind of gotten in the rhythm. We as an executive team went from trying to figure out how to subsidize our employees, making sure that our clients, much like you, were taken care of, responding to inbounds for, again, the needs for digitalization. And again, on the exchange side, we power all of the markets from a market operator perspective. So there was a lot of making sure that the markets just ran effectively, which was really important, especially as it relates to just showing confidence. But now everyone's sort of gotten adjusted, and I don't like to call it the new normal, but it's certainly the normal for now. So it doesn't surprise me at all that what you're seeing in your client group is shifting, because that's definitely the case with our clients, and that would be whether they're market operators, whether they're the retail online brokers that are our clients. They've obviously been dealing with enormous volumes and volatility. But as well as how we're all looking at our forward plan. So this doesn't surprise me. It's completely in line with the way that we're behaving. Obviously working with management teams in the portfolio, that's not necessarily directly applied to us. But we did close a deal quite literally right before we all went home. So I haven't been to the Dallas office, which is the new team. Since COVID hit. So everything's been online, and that's not to say we haven't had great wins, and we're still doing pitches, and we've got our integration plan. So you're just kind of seeing everyone adjust. So these numbers make sense to me, and I think they make sense to what we're seeing with our client group as well.
Well, it sounds like you're executing very effectively. The stock price would certainly indicate that, and you've built some tremendous businesses across the information services side, across the private capital market side. So congratulations on the success and everything you're doing at Nasdaq. We're excited to spend time with you here today. We thank you for the thoughts and the contributions. I am certain that we will be working together this year as our clients build APIs between Solovis and Chronograph and all of the different portfolio management technologies and platforms that you have that are complementary to the DealCloud platform. So this has been a great discussion, and we really appreciate you joining us today. Thanks for coming.
Thank you for having me, and we're looking forward to building those APIs.
That's great. Well, we'll look forward to hosting you in the office and not over Zoom as soon as we're back in there.
All right.
Have
Thank
a
you,
great
Ben.
evening. Thank you.